We know everyone is still coming in, but we're going to go ahead and start because we have a lot of information to cover. So, hello everyone, and welcome to our webinar, Wildfire, Devastation, and Insurance Fallout, What HOAs Need to Know. My name is Miranda Ward, one of your client relations directors here with Davis-Stirling. We are thrilled to see so many of you today. We have a lot of information to cover, so we're going to get started. Before we begin, this meeting is being recorded. If you require closed captioning, please request it at the bottom of the screen. This video will be available on our YouTube channel after the webinar is processed. You'll see a link in the chat pop up right now. We will be taking questions via the Q&A function to be discussed at the end of the program. If we do not get to your question, please check the newsletter. Remember, some questions may be answered as the presentation progresses, and too specific of questions will not be addressed. Now, on to the presentation. Please welcome Adrian Adams, Michael Berg, and Terri Guest.
Hello, everybody. Okay, and I think you have some questions for us, Miranda.
All right. So, what was the condition of the market prior to the January fires, and what are we looking at going forward?
Mike, before you answer that, let me give a little bit of background on the fires. The Eaton and Palisades fires destroyed, 16,000 structures?
Something like that.
UCLA estimated the losses at between $95 and $164 billion. The LA Times estimated at $250 billion. And of those losses, only 75 billion were insured. The rest, up to 175 billion in losses, were not insured. And so that clearly is going to impact the market. So Michael, tell us about the market.
Yeah, sure. So one of the important things to do or to think about too is that it's not over. Right now, CAL FIRE reports they're fighting 480 wildfires in the state currently. There are 57, almost 58,000 acres burned, 29 fatalities, and like Adrian mentioned, about 16,000 structures. There are over 104,000 emergency responders currently working on fires. So my heart continues to go out to them because it's not over. We're just not hearing about it. When we were looking at our progress, and by we, I'm talking about organizations like Community Associations Institute, CLAC, an insurance task force that's been working with California legislators. When we were looking at what 2025, when we were looking at the end of 2024, what 2025 was going to bring us, we started to see a little bit of the positive traction that we had made. It was kind of like we could feel that two steps of moving down the road to some sort of solution that we were working towards for more than 4 years. And the Palisades fire and the Eaton fire put us 5 steps backwards. They really took a lot of the work that we had done and changed the game. One of the main things that's changed is this perspective of properties that are next to brush or open space are the ones that are at risk. And Palisades completely dispels that myth because these are properties that are on flat communities that are not up against hillsides, that are not up against open space, and yet because of this type of event, these properties were completely destroyed. So we now need, insurance carriers are going to be throughout 2025 looking at how that exposure has changed their perspective on insuring structure.
Agreed.
I
know when we went recently to the law seminar in San Antonio, we meaning the insurance folks in the group, we had a shop talk session and we heard some really positive stuff from Florida, and usually California follows what's happening in Florida as far as the insurance goes. So things are improving in Florida, which is great news for us. But I think because of this recent occurrence, those positive steps are going to be farther away.
Yeah, and we also heard some really positive stuff from Oregon. The state of Oregon is working on, or has at least submitted, I don't think working on is the right term, but working on an exclusion or a definition of wildfire separate from fire, so that we can, in the insurance industry, look at how we want to apply coverage to that exposure. Whether we do it, or carriers do it from, like we do earthquake insurance. Well, in California, we don't cover earthquake insurance, but you buy an earthquake insurance policy separate from that because it's excluded on your main policy. Can we do that with wildfire, which would conceivably invite the preferred carriers like State Farm and Farmers and the ones that we know, the commercials that we see, back into the marketplace and give us a more reasonable pricing structure?
So the insurance task force is working on that. We do have the language written for the legislation. We just didn't pick up an author, but Oregon did, and Oregon is submitting it. And I think if they are able to put that through, it'll bode well for California, right? We might be able to follow suit, which would be amazing for everyone.
Okay, Miranda, next question.
Why did some carriers stop writing insurance in California or leave the state altogether?
They hate us.
I can answer this one. So the Department of Insurance, admitted carriers in California have to submit their rates and their policy forms every year for approval by the Department of Insurance. And back in the 80s, a proposition was submitted that seemed like a good idea at the time, I'm sure, but it limited how much insurers could increase their premiums year over year. So fast forward to now, all of these years later, these insurance carriers have not been able to keep up with the costs of doing business in the state. And they're not allowed to increase their insurance rates unless they submit for an intervener process. That process is expensive. It takes a lot of time. So not a lot of carriers are willing to do that. Just recently, you heard that State Farm submitted for like a 22% increase, and it got
22%.
denied. So there you have it, and that's why the carriers are leaving. If it is not profitable to do business here, any business, insurance carriers included, they're going to leave. So that's why they're leaving the state.
Yeah, and I think it's a mistake by the insurance department not to be granting these increases. I know it's hard on owners to pay higher premiums, but at least there's insurance available.
Right.
With the carriers pulling out of the state or not renewing, not writing any new policies, we had a lot of our clients who had to go to non-admitted carriers, and we had some who had, over the course of 2 or 3 years, 800% increase in premiums.
Yep. Yeah, and I know one of the questions that we have is, how is the Department of Insurance, how is the governor's office, pardon me, helping the process? And while the governor's office is trying, or while the Department of Insurance is trying by delivering these opportunities for carriers to use different pricing models and to avoid or circumvent the Prop 103 pricing structure, which will raise premium from the preferred marketplace. So people are freaking out, right? We were with Farmers, let's say Farmers, and Farmers or State Farm canceled us, so we had to go into the surplus market. And that was really, really expensive. And it, as Adrian just said, 800%. That's not uncommon, sadly. So what we want to do is bring the preferred carriers back in, but in order to do that, they still need to change their pricing. They're going to raise their rates. So what you paid with State Farm or Farmers or other preferred carriers years ago is out the window. We're never getting back there. But we will get back from this exorbitant price in the surplus market, because these carriers are the ones that are carrying all the burden. And their reinsurance company carriers are carrying all the burden, so they're pricing it. And because they're non-admitted, they're not subject to that rating structure in California. They can choose to price it or not sell it at all in any fashion that they want. So the Department of Insurance came out and said, well, you insurance carriers, you can use predictive models rather than traditional modeling. You can circumvent the rating factors, and you can charge more premium for what you want. However, you have to write a certain percentage of your market share in the wildfire stressed areas. And carriers kind of say, that's great. thanks for the opportunity, but I don't want that exposure. So I'm not really going to work, at least what I'm seeing thus far, is I'm not really going to work to buy that or to sell that insurance because I don't want that exposure, even if you're giving me the opportunity to price it right.
Is the FAIR plan available for homeowner associations?
Not yet. It will be. It sort of is in that the FAIR plan, Terry, check me if I'm wrong, but the FAIR plan has increased their limit to $20 million. Has that gone through?
Yeah, there are some associations that are with FAIR plan.
Okay, so
but it's not, the FAIR plan was never intended for homeowner associations.
Mm-hmm.
It was never intended to cover as many businesses, homes, as many policies as they have right now. That was never the intent. That's why they're not actuarially sound. So they're kind of pivoting a little bit to try and make square pegs fit in round holes. So while it's not available for every community, it's only available for smaller communities.
Yeah, and
it is available.
And the FAIR plan has communication with the department to try to make it available to HOAs, changing some definitions, allowing them to, because they see the location as the entire community rather than each building within the community. And if I have a community that's more than $20 million in property replacement costs, I don't fit. Mm-hmm. So they're changing the definition to include or to define the building as a location and therefore fit into the FAIR plan model, but that doesn't do anything to help the FAIR plan solvency problem. It doesn't change, and it's going to be the same. It's going to be pretty much the same problem that we're seeing in the surplus market because those carriers are all reinsured by the same carriers, and they're charging those premiums. And when you look at the FAIR plan versus another surplus carrier, the FAIR plan is just fire. It's not water. It's not liability. It's not anything. It's just fire insurance. So it's actually, you're going to be paying probably the same amount of premium you are today with the surplus market, but you're limiting your coverage to just one peril.
Right. And I want to add too that the FAIR plan is the insurer of last resort, literally last resort. If you have zero other options, then that's what you go with. But excess and surplus lines markets, they're not bad. I don't want to make it sound like we shouldn't go with those. They're fine carriers. Many of them have been around hundreds of years, and they offer great coverage. Is it going to be more expensive? Yeah, sure, because they can charge appropriately for what you're getting. And if you do end up with a FAIR plan policy, then you're going to have to buy extra insurance to cover all those other things that are required by your governing documents and the Davis-Stirling Act and all that. So it's going to be expensive. It's not a great plan.
Okay, Miranda, next question.
What if insurance is expensive? Should the board get less than full coverage?
That is a good question.
Yeah, there's a legal answer and an insurance answer.
Right.
Right. Let's do the legal one first.
Let's do that.
Because we do get this question. It's come up with a lot of our clients where they just can't find the insurance, the amount of full coverage that they can afford because it is so expensive. And so they ask, can we get less than full coverage? And the problem is the CC&Rs say that you have to reinsure, well, almost all that I've seen, 100% coverage. And so you've got a board, if it decides that 100% is available, but it's too expensive, so they get 80%, 70% coverage, there's some risk to those directors. Because if the building's burned down in a fire and there's not enough insurance coverage now or money's available to rebuild, the board's going to get sued. You reached your fiduciary duties. You didn't do what the CC&R said. You didn't get full coverage. And so there's that risk. If they ask me, I'm going to tell them get full coverage and special assess the members to cover it. So, Michael?
The sad truth is sometimes it's not available, and sometimes it's just simply too expensive for an association to accept. Pardon me. The thing that, from the broker perspective, our job is to bring to the table everything that's possible and available, and that's going to mean you board of directors, you community manager, are probably going to see a number on a piece of paper that makes you pass out. If we're talking about a large enough community. I have a community in San Diego that just renewed their coverage. Last year they only purchased 50% to value, and now they purchased that additional 50% this year because they had so many problems and were so concerned about being underinsured. And they're one of the communities that actually backs up to some of this brush area. So they incurred that, but we brought that to the table, and the board of directors made the decision. The important thing from my perspective is that the board of directors works with legal counsel when making that decision not to buy a full limit or to buy what we would call a loss limit. And you do that because you can then create a doctrine of impossibility, right, Adrian? There's something that the association can put together, how we went about this and why we decided to do this. It's not going to stop the lawsuit. It's not going to stop the lawsuit, but what it is it's a means to defend the association for the decision that was made.
Yeah, and that's exactly right. They need to document completely all the efforts that they made in trying to get insurance, what was available to them, what the costs were, and the impact on the community. And so they at least have a defense. It won't stop the lawsuit. You're right. They're going to get sued, but at least they have a defense.
Yeah, and I would recommend to a board, why don't we just do it? I recommend to a board that you get that full limit quote from your broker, or you ask for it and you let your broker say it's not available. Mm-hmm. Don't say, well, we only want to buy X because that's what we can afford, or that's what we've had. Get all of those ducks in a row so that you can defend yourself.
I also want to bring up the very important fact that if you don't have full insurance to value, that means there are no loans or refinancing options available for those owners in that community. You're not going to be, the only sales you'll be able to make are cash sales. And cash sales sometimes end up going to investments, and then your rental percentage goes up, which causes a whole different set of issues, right? So if you're in one of those communities that either cannot get full coverage or chooses to not have full coverage, make sure that your community, that your membership understands that that's going to be part of the backlash.
Amen.
Okay, next question.
Boards impose a special assessment, or do they need membership approval if it is over 5% of the budget?
Okay, well, first of all, should they even put it to a vote of the members? If they put it to a vote of members to special assess to pay for the extra, full coverage, the extra premiums, members tend to vote no on special assessments. And so the board then would get less than full coverage, and then the fire event occurs, and then they get sued. The plaintiffs the argument that's going to get made is that the directors are the ones that have fiduciary duties, the members don't. So the members can vote things down when boards should be imposing it, because they're the ones that have the authority and they have the fiduciary duty. They can't transfer that to the membership. Now, they will certainly say, look, in defense, we put it to a vote of the members said no. But again, they're going to get sued. They can defend by saying they put it to a vote of the members, but plaintiffs are going to say you never should have put it to a vote of the members. And so it should have been an emergency special assessment, which the board can do on their own authority in order to pay for it. So it gets back to what Mike was saying, and that's fully documenting what's available on the market, what you can get, what the costs are. And then also you may be looking at what really can the membership afford or not afford. And it may be that you're in an association where people are really strapped, they really don't have, it's an older community, they're on fixed incomes, and that's a real problem. And so you have to work with legal counsel to figure out how you're going to deal with this. But if you're in an association that is relatively wealthy and you choose not to do the special assessment, I think you have a problem. So Mike, you want to add to that, or Terri?
I think I'll yield to Terri shortly, but I think the important thing to take away from that is the fact that the board of directors was elected by the membership to make this decision.
Right.
And if you don't make the decision, you kick it back to the membership. What's the point of your authority? You have to make smart business decisions, the best decision you can make at the advice of experts and in good faith. That's the business judgment rule. And doing that doesn't mean asking the membership if they want to pay $1,000 more for insurance. That's, of course they're going to say no. I don't want to pay that. And now you're between a rock and a hard place. Terri?
Right.
I would add that you still want to communicate to the membership. You want to make it perfectly crystal clear
Right.
why you're doing what you're doing, right? So having town halls, having counsel, and having your insurance professionals there to explain what's going on and why. You don't want to have this come as a shock to your membership. Oh, your assessments are going up $1,000 a month, and they're going to freak out. So transparency and communication are the most important part of this, especially if it doesn't go out to a vote, which it sounds like it shouldn't. Then yeah, you need to let them know what's coming and why and how to prepare for it.
And I wouldn't wait until you're getting that proposal at the last minute. Prepare your membership, work with a professional who knows this market and can advise you mid-year, early on. I'll tell you right now, expect a 25% increase in your cost of insurance next year. Is that what we're going to strive for? Of course not. But prepare yourself for something that could be quite impactful, even more so than, that's not to say the past couple of years haven't been impactful. The point is, it's not getting better. So talk to your membership about what's going to happen. Invite your professional in to have this conversation with your board of directors and a town hall meeting in June when you renew in December. Because the more, as our friend Kimberly Lilly says, clarity is kindness. The more we can share the reality, the more we can set expectations, even if they're not the expectations that someone wants to hear, the more you know what's really going to happen and can prepare yourself for it, the easier it is, even if it's bad news.
Yeah, and I'll add one more thing. I had a board say to me, if we special assess at that level and cover the insurance, we will get recalled. They'll recall us from the board. And my response is that may be the best thing that can happen to you.
Sure.
Because now you're off the hook.
Right.
So again, just do the right thing.
Yeah.
And make sure that you're getting appropriate levels of coverage. That's whatever's available that you can get.
I like that. Adrian, do the right thing. He's bringing in Spike Lee.
Okay, Brenda, next question.
What can an association do to mitigate the cost of insurance?
Right now, very little.
Well, no.
Hang on. Right now, when we're talking about wildfires.
Right.
Right? Right now, very little. Right now, the price of insurance is driven by location and the carrier's appetite. You can even talk about deductibles, and some carriers are excluding wildfire. I don't want to get into that because that's a whole nother legal
hour.
But so from a wildfire perspective, there really isn't much that we can control. I'm going to let Terri go into where she was about to go.
So right now, the best thing an association can do, instead of looking for discounts on their insurance or trying to make their insurance more affordable, what you're trying to do, your first intent is to make your community safer. And when you make your community safer, that in turn will make your community more insurable. And then you may have better options for your community when the insurance comes into play. So I was at a presentation last week. I was in a presentation last week in Channel Islands chapter of CAI, where I was with two wonderful people. One was with the FireWise USA program, and the other was with a Fire Safe Council for that specific county. And they had so many resources that were available to communities, to individual owners, I learned so much just sitting next and sponging all this information off of them. So what your communities can do, you can become a FireWise community. You can work with the Fire Safe Council. And there's another program. Right now, it's only for individual homes, but a community program is rolling out through the IBHS, the Insurance Industry Business. I can't remember.
Insurance Institute for Business and Home Safety.
There you go. So if your community is designated as a FireWise community or has the certification through the IBHS, then according to the Department of Insurance Safer from Wildfires program, your community and your individual owners are eligible for discounts from these admitted insurers that are participating in the program. So most community associations do not have insurance through those carriers that are going to kick you back a discount, but your individual owners might. So that means that your individual owners can get discounts on their personal lines, personal homeowners insurance. So they'll be able to see savings there. Also, I found out that the California Fair Plan is required to give discounts for those FireWise communities and with the IBHS. So if your community is insured with the Fair Plan, hit them up with your FireWise community certification and you can get a discount there. So that's positive. So the main thing that us as insurance professionals, what we try to do for you is paint a picture of your community for the underwriters that are going to make the decisions on if they're going to insure you and if so, for how much. So we need all the information we can to paint this beautiful picture. Now, right now we're talking about wildfires. So look at the information that is readily available online. There's grants available to communities to get some of this work done as far as home hardening and community hardening and landscape changes and all that. Apply for grants. You can get, there's tons of information and tons of resources out there to make this stuff happen. The other stuff doesn't have to do with wildfire. It has to do with your community and just the way it is. Deferred maintenance is going to probably hit you worse than if you're in a wildfire zone. If you're a community that was built in the 60s or 70s and you haven't upgraded your electrical, your roof hasn't been replaced in 15 years, you have all these other issues, then that's going to prevent you from getting insurance far more than if you're in a wildfire hazard area, in my experience.
Yeah, and I'll add in those fire hardening measures, again, as Terri said, we're not talking about mitigating the cost today. What you're doing is preparing yourself for an opportunity to take advantage of lower costs when they become available to you, or giving your membership an opportunity to take advantage of them in their own personal lives right now, right? That's, but the fire hardening thing of a building as well is another step. So you got the FireWise, you've got the Safer from Wildfire and that stuff. There are a number of options, specifically vent caps, or vent covers, chimney caps, different types of roofing materials that are being shown to be very effective in protecting a property against or protecting a property from wildfire loss. There's one community in particular in Anaheim Hills that we work with that started 3 years ago with a project to replace roofs, replace chimney caps, put vent covers on, all to protect them from wildfire. They're still with State Farm because State Farm said, "Oh, look what you did." Now, I'm not saying that's the rule. It may be an exception, but it is an example of what a community can do right now to protect it. As Terri said, make your community safer. That's goal one. Your community needs to be safe. And then if you get advantages from that, fantastic. But your community is safe.
Yeah, to follow up on what Terri said, yesterday I met with an association that hired a fire consultant and who prepared a report. And then we had a 2-hour meeting with that consultant because the association is concerned about keeping the community safe and removing trees and opening up fire evacuation routes and doing things to make the community safer. And so that should be a goal in itself. And then finally, as you both pointed out, at some point, it should help get insurance and or lower the cost of insurance.
What's the exact, what is the evacuation plan? It's like CE, CERT. Thank you.
CERT training.
That was the thought that came when Adrian was mentioning that, the evacuation plan. So consider CERT as well. Do what's right, and that's what's important. The thing that really not really, as if I was telling you stuff that wasn't really before, but recently the conversation has been about how this market has hardened such that 5 years ago an insurance carrier said, "Oh, I will insure that. I will absolutely do that. We will grandfather you into anything. We will, that was the code when you were built in 1980, therefore we're going to ignore it until today." And now insurance companies are saying, unless you are a good risk, I'm not even going to touch you. I'm not interested. And that's another piece of this wildfire puzzle or the insurance puzzle in California that was kicked off by the wildfire world, is now insurance carriers are re-underwriting their entire book, and they're saying, you know what, I'm afraid of wildfire, but I'm also afraid of this and this and this, and I want to see that you've addressed those things before you become a risk that I'm even interested in reviewing, and then we will start talking about what the price is going to be.
Yeah, and that includes like aluminum wiring and Z-scope panels and anything that's going to create a risk of fire within the community.
Yeah. Well, I mean, let's skip down to that question, right? What is the question that is on our list, Miranda?
You know what, real quick, just to let everyone know who's listening. So I live up in Placerville and I live in a road association. So we're not a typical CID, this and that. You guys can reach out to CAL FIRE and they'll have representatives who will come to your annual meetings, will come to a town hall, will go over all of the things that you need to do as just separate homeowners to help the association as a whole, and then potentially get to a FireWise.
Yeah.
FireWise doesn't have to be just one association. It can be a neighborhood. It can be a large geographical area.
Yeah.
Yep. But everyone has resources. Just reach out to CAL FIRE, and they've got specialized people who are used to and trained to come out and make these talks to the communities and stuff.
Yeah.
All right, next up, can the board amend the CC&R so they can obtain less expensive insurance by reducing the amount of coverage?
And the answer is yes, they can. And we've been doing that for a lot of associations. And so you can insert language, because right now the language typically is you're obligated to get 100% coverage. And as we've been saying, sometimes it's not available, just not available at all. Or it's so expensive that it's just beyond their reach. So, one of the things you can do is, of course, boards can adjust deductibles if that's available. Go to Bare Walls Insurance. But as far as language that we're putting in CC&Rs, is that they're obligated to get 100% replacement cost if it's available and economically feasible. And if it's not available or feasible, then they can get less than full coverage. And then we give 6 factors to determine economic feasibility. So yes, you can amend your CC&Rs to give boards some flexibility so that boards of directors are not at risk if they get something a little less than full coverage.
I was gonna tag onto the end of that a snarky question, which is, how do you define who gets to decide what is economically feasible? And you beat me to it with an answer.
Yep. Yeah, we put in factors so that they can decide.
So the intent of making that amendment is to protect the board of directors from potential liability, yes?
Well, and also to give flexibility in order to get coverage that may be less than 100%.
Yeah, that's really smart. A lot of the ones that I've seen have just said the board can make this decision, and it's, to use the language, if it's not economically feasible. Okay, who gets to decide that? That's going to be decided in a court of law.
Right.
And the judge is going to decide what was economically feasible.
Yeah, because that's too loosey-goosey. We
Yeah.
put in factors.
Yeah, that's beautiful.
Okay, next.
Right. Does the board have a duty to harden their association against wildfires?
Arguably, yes. So I don't know that there's a legal, statute that says you must do this, but there is AB 38. That's the Defensible Inspection and Compliance Reports. That started, July 1 of 2021. And this is what I think, Terri, you were talking to earlier, and Mike, you as well, and that is hardening the buildings. Then this is sellers. Sellers are obligated to tell a new buyer whether they complied with it or not. So the question is, do the associations, the condominium association board of directors have to do this? And I think yes. And that is putting in those ventilation, the grills that don't let embers into the attic spaces. Changing out the roofs so that they're fire resistant. And if you've got wood shake roofs, definitely stripping those off and putting on, tile or something that's gonna not catch fire. And also, dealing with the landscaping around the homes, and they've got the 100-foot radius around the home. And so within the first 30 feet, which is zone 1, and then from 30 to 100, zone 2, there are requirements that they're supposed to meet that the fire department requires them to do. And boards should be doing this within their associations. The condominium association, get trees away from the buildings, get rid of all the palm trees. I can tell the palm trees in the 3 different fires, the Woolsey fire in 2018 in Malibu area, and then the Palisades and the Eaton fires, the palm trees just explode, and they send fire in every direction. In other high-risk trees, pine trees and eucalyptus trees. Eucalyptus trees, because they have a lot of oil in their leaves and bark, and so they catch fire. They burn really intense. And so removing those trees and replacing them with trees that are less likely to burn, like oak and maple, walnut trees. I mean, they're more resistant to fire. And then, limbing them up and getting rid of hedges underneath the trees, because hedges underneath carry the fire up into the trees then spread it to the structures. So it makes sense for boards to do this. And if they don't, again, the lawsuits will fly afterwards. Why didn't you do it? You knew all about it. There was AB 38. There were all these fires, and it's all over in the news. And you sat on your hands and did nothing. That's going to be hard to defend against.
Yeah, the duty versus the responsibility to harden, like you said, I don't know of any law that says you have a duty, but
right.
As a board of directors, going back to what Terri and I were talking about previously, doing the right thing, you have the responsibility to make sure your community is protected as much as you can.
Right.
And when you do put all the information and you keep good records of what you've done and why, or what you haven't done and why not, that puts you in a position, you as a board of directors, that we can defend you, or the insurance carrier, I should say, because these 4 people here aren't going to be the ones doing the defending. But the insurance carrier can. And a lot of that stuff, Adrian, that you were talking about, defensible space, trees, limbs, that sort of stuff, is identified in a loss control inspection that carriers will most likely do on an annual basis. At least I've seen that for the last couple of years, and certainly going forward. When a carrier writes a new piece of business, they always send out an inspector to make sure that, well, essentially what we as a broker told them they were insuring, they are insuring. And they will identify those things that they want to have cleaned up. In the past, loss control inspections have delivered loss control recommendations. While that word recommendation suggests that we recommend you do this, it's really more of a mandate. we recommend you do this, and if you don't do it, then you're not going to be a risk that we want to stay on. So
Right.
so you need to really don't fear those recommendations though. I think that's the thing. I can't tell you how to feel, but they come in and people go, oh my gosh, I don't want to do this, and this is now I'm going to be scared, and I'm going to go find a new carrier that's going to ignore this recommendation. They don't exist. They're all going to ask the same question. So you're going to have to do it. So just see it, understand that it's in the best interest of the community, and get it done.
It's for the protection of the community and members too. And as far as the duty to harden, the governor did recently sign something about a 5-foot rule. I think that's only going to apply in certain geographical areas. So if you're in one of those areas, I'm sure you're going to hear about it very soon. But yeah, so that could be coming as far as law. And I've heard from some arborists that the requirements vary from city to city, county to county, as far as how far away trees need to be from roof lines and things like that. But
Right.
resources are definitely available online to help you with that. And like I said, there's grants available to help communities with that as well.
Yeah, and the difficulty for boards is that you have some people who will chain themselves to trees.
Yeah.
Although I think in the current environment, they're going to have less of that. This is the best opportunity to actually get in and get stuff done.
Yeah.
Mhm.
Fair.
Okay, Miranda?
Oh, you're muted. There we go.
Details, thank you. Do the damage and destruction provisions in CC&Rs need to be amended?
They're all over the map. I can tell you that it depends on how the particular law firm that drafted the CC&Rs wrote those provisions, and some of them are unreadable. You can't understand what in the world they're saying. And so they may need to be amended. And they have different formulas for how to determine if there's not enough insurance coverage, not enough money to rebuild. The members have to vote either to yes to rebuild, vote no not to rebuild. What percentage of them have to vote in order to make that decision? And if you vote not to rebuild, then what happens next with the insurance monies? How do those get distributed? What if, and we have clients that lost buildings in the Palisades fire. And one had 2 buildings, one that was burned to the ground, the other one was untouched. And the condominiums still exist because they're cubes of airspace and they're in the air, but they have no building, no structure around them. And so what happens with those? And so how does the money get distributed to them? And insurance money, do they receive or not receive it? Do they have the ability to sell? And so as a block, all of them get together and they sell to a developer who then rebuilds the building. Do they partition it so it's no longer part of the association? And that means going into court. So it's amazing the amount of things that are set in motion that need to be dealt with. And as attorneys, we immediately turn to the damage and destruction section and read it to see what it says. And hopefully we can understand what it says.
What role, Adrian, does a lender play in that process or that decision?
Yeah, well, I don't know that they're necessarily mentioned in the damage and destruction section. Some of them may, but certainly the lenders are going to want to get paid because for whatever loans were out on those units. And so is the association have obligation to contact them and pay them directly, or according to the damage and destruction section, does the money go to the owners and the owners have an obligation to contact their lenders and pay them? So again, these sections suddenly become really important to read, and boards may want to actually sit down and read them themselves. And if they can't understand them, talk to legal counsel because it may be time to amend your documents. And this is also a good time then to deal with the insurance section.
Yeah, I think I'd go global, but this is a good time to amend your documents, especially if you have one that's 60s and 70s.
Right.
We've got laws have changed, statements have changed, the world has changed. We need to catch up, and those documents are way out of date.
And please include your insurance professional when you're doing that. Please.
Yes.
We're free. We're free.
Sort of.
Okay, Miranda, other questions?
All right. What should a board of directors watch out for in their D&O policy?
Okay. So there's been a few changes in the D&O marketplace over the last couple of years, mainly because claims are going up. Insurance carriers are paying a lot of money in defense, and those defense costs have been skyrocketing. A lot of the claims payment isn't about the settlement. It's about the cost of the attorneys to defend and the cost of the attorneys who are bringing the case, the plaintiff side, if you will. And so carriers are moving things from what we had was defense cost outside the limit of liability. Let's say we have $1 million directors and officers policy. That $1 million has traditionally been available for judgment or settlement. All defense costs, court fees, and other expenses were paid outside of that limit. They didn't use up that $1 million limit, essentially saying they are unlimited. Well, a carrier is going to resolve the issue, resolve the matter as soon as they can, so that there is a limit to it, and that is when the carrier decides we're done paying for this. And then they use the $1 million for the settlement or judgment. Now carriers are putting a limit on their defense costs and saying we will defend you up to the limit that is equal to your limit of liability, and then we're going to start eroding your limit of liability in the defense. The other thing that some carriers have done is they have removed an exclusion for failure to maintain or procure adequate insurance. Go back to the conversation we were having about the association not being able to purchase enough insurance, and that association is destroyed in a fire. The members of that community are going to sue the association. And the association's D&O policy has an exclusion for failure to maintain insurance. The D&O carrier is not going to defend that loss. So you got to watch out for that exclusion. It's only really a big deal if you have a community where you've done something like that, where you've had to make that decision to not buy the coverage, and that's what makes it all more important to have all the information, to have gathered all of the resource or talk to all the resources you can to put yourself, you as a board, in a position where the insurance carrier can defend you for the decision that you made, and not say you didn't make a decision, because not making a decision is not a defense. You have to be in a position where the carrier can defend you. Terri, do you have anything that I've missed on that?
I call that a defensible position.
Yeah. Yeah, and the D&O market's not going to get better. I would anticipate, while we're seeing the property insurance market in California go nuts and nationwide basically go crazy, we're going to see some changes in the liability side of things too. They may not be as dramatic. I don't think they'll be as dramatic as we are in the property, but right now, you think about your D&O policy, your average D&O policy is somewhere in the $1,000 to $2,000 premium a year. And the carrier's on the hook for $1 million. That's pretty cool for the insured, but that costs a lot of money for the carrier. So they're going to need to find a way to support their loss conditions.
Okay, Miranda.
Outside of wildfire, what other issues does an HOA board need to address?
Go get it, Terri.
That goes back to what we were talking about a little bit before, deferred maintenance, making sure that we are able to paint a positive, proactive picture of your community. Someone said in a presentation, I think it was about tree care, proactive is less expensive than reactive. So if your board of directors and your community can be proactive in preparing for wildfire, hardening the community, if you are proactive on getting the roof replaced when it should be, replacing the pipes if they need to be replaced, checking on those electrical panels, and even if you don't having an inspection of all of these elements too, especially if they're aging infrastructure. So have an electrician come out and inspect your electrical panels and provide a report. A plumber come out and provide a report on what kind of piping you have. The electrician can provide a report on what kind of wiring you have. The more information that you can gather to provide to your insurance professional, the better picture we are able to paint for you. And also you as a board, and then you as managers are able to figure out when you're budgeting, and you can have things added to your reserve study as well if you need to plan for major replacements like this, because nothing is going to get less expensive. So being proactive, trying to foretell the future, and see what you need to do to keep your community maintained. Also, and this sounds silly, but go on Google Earth and look at what the picture at street view and overhead views look like for your community, because I guarantee you the underwriters are. And if the underwriters are seeing a picture of your roof that is 5 years old and you had your roof replaced last year, you're going to need to get that information to them up front so that they don't come back and decline you because your roof is old. You can say, when we're submitting the applications, we can say, we know that on Google Earth, this is what the roof looks like, but here's what the roof looks like actually right now. So being proactive in information, in maintenance, all those things the managers tell you to do all the time anyway. They're right.
Yeah, and to add to that, you should be proactive. And if you get a report that says you need to do the following things,
Yes,
and then you do nothing, you are in a much worse position.
absolutely.
So you need to have a plan. And even if you can't get everything done at once, if you have a plan and you start implementing it, you're in much better shape.
Yeah, the market, the way it is today, and how carriers have moved from what we would call a soft market, where they were just saying, hey, yeah, sure, we'll write it. We want to, whatever premium, we'll be competitive, what have you, versus a hard market. Nope, we're not interested in that. We want it to be X, Y, and Z. Carriers are looking at properties that are older than 30 years as requiring updates, requiring upgrades. 30 years old. That's 1995. That's just insane to me that we're looking at 30 years ago and saying something that was built in 1995 has a component, particularly an electric component, that needs to be upgraded, updated. That's an important thing to consider, because carriers are going to stop writing that product, that project, if there's no plan in place to address that electrical component. I had a conversation with an electrician about my own panels, because all this is coming up, and I was like, I want to know more. I want to help me understand why an insurance company is saying I need to do this. His answer was, the useful life of a breaker panel is about 30 years. So even though it was a fine component, even though it wasn't a Zinsco panel or a Stablock or a GE Sylvania panel that the insurance companies are all saying, you got to get rid of these things. This was built in 2007. The panel itself has a useful life, just like any other component, just like your plumbing fixtures, just like the braided hoses behind your toilets, just like your roof materials have a useful life. They all need to be changed, even though they're not seen as the culprit. And insurance companies are looking at all of that. Anything over 30 years, anything that is those, like I said, those Zinsco panels, I'm sure plenty of people have heard that tale. And again, as Terri and I have said, be proactive. I love that the arborists. Proactive is less expensive
than reactive.
That's fantastic. Mm-hmm. And start it early, because if you have a plan and the insurance company says, hey, wait, I want to talk to you about this thing, you can say, oh, we started that plan. We have the bids. We're working on this. We've got it scheduled. You can give that to them, and in Terri's words, that paints the picture that we want to paint so that we can get you insurance.
Yeah. And this is where it's important to have solid reserves, be properly funding your reserves. You've got the money to be able to replace those components.
And actually performing the replacements.
Yeah.
Yes, not just sitting on the money.
Right. There's so many underwriters now that are requiring us to provide a copy of the reserve study to them.
Mhm.
So the first thing I look at when I get the reserve study from the manager is how many zeros are on there under remaining
Yeah, it looks
useful
like
life.
we lost her.
We didn't lose her. She's right there. We lost you.
Yeah, we lost you. I think we lost you.
Oh,
So did you hear what I
really?
said about?
There was a glitch in the matrix for
Boy,
Adrian.
no kidding.
So yeah, if your reserve study has a bunch of zeros under remaining useful life, that's something that needs to be addressed.
Yeah, we had a community in Dana Point that the carrier called that out. We had a preferred carrier ready to go, and they said, "Wait a minute, all of these components are zero. They're past their useful life, and you haven't funded for them. We're not going to insure you." And now they're in the surplus market, and so they're paying more insurance cost while they have to recoup or recover their reserves and replace all of those components. So those have just added up to huge expenses to that community.
Yeah, and that's a formula for large special assessments.
Mm-hmm. Yeah, larger than life special assessments.
Yeah. Okay, Miranda, more questions?
We're good with all of the pre-transcribed questions. If you guys are good, we can go ahead and move on to the live questions.
Sure.
Okay.
No, I'm out. See ya.
Way to put me on the spot. All right. We will now move on to the live question and answer portion. We've been recording your questions via the Q&A box. If there are any questions we cannot get to today, please look to our next newsletter. If you have not already subscribed to our newsletter, please make sure to check it out. We will post a link in the chat right now.
Best newsletter in the industry. Love it.
Well, thank you. All right. First question. Here at DRE, we are seeing a few developers starting to create subs to pull down coverage for specific product types in an overall project that traditionally would have had a single HOA with cost centers. With the subs, you will have multiple carriers spreading the risk in a single project.
I love that. Thank you. Whoever said that,
Yeah.
thank you. We have, so to speak that back in English for anybody that didn't follow, I'll give you an example. We insure this one community that's enormous. It's like 1,000 condo units in, I think, 30 buildings. And the total insured value on that complex is almost $300 million. That's a lot of money for one insurance carrier to invest in one very concentrated area, right? So if we've recommended to them, if you split it up by building, make each building or each little cluster of building a sub-association, and then the master just association insures the common area, then you can split it up amongst a few different insurance carriers. You're much more insurable that way. That's what they're talking about. So instead of developing a brand new development that's enormous under one HOA, they're developing an enormous community that's split up into smaller sections. And that's those are smaller bites to chunk off for insurance carriers. I love it. Thank you, whoever said that.
The other side of that is you open yourself up to, not only are you a safer, using that in quotes, a safer risk because there's some diversification among the carriers that are in that community, but you also open yourself up for opportunities from carriers who have lower maximum total insurable value thresholds. So there might be a carrier that would not entertain any piece of that risk because they only want to write $20 million worth of property. But if you split it up and you have an $18 million project within that large community, now you have that carrier as well to start looking at as an insurance option.
Okay, next question.
All right. All right, this one. I have been struggling to understand. Okay, so this is for the EV lithium battery.
Okay.
I have been struggling to understand which insurance applies, car or homeowner's insurance, in the event of an EV lithium battery fire in a common area concrete parking garage with 6 stories of residential above it, specifically due to an active nature like a severe storm resulting in flooding in the parking garage.
So The insurance company, the insurance carrier that insures the building is going to address the fire damage. The insurance company to the building. The insurance company that insures the car is going to address the fire damage to the car. As long as this was the reason for the fire is a covered event, such as what was described in the question. I would probably use electrical surge before I would use storm as the example, but I understand exactly what you're saying. There's an electrical surge, the car, the battery exploded, it started a fire. The building insurance is going to cover the building, the car auto insurance is going to cover the car, assuming, of course, that person has comprehensive coverage on their vehicle. If you don't have full coverage on your car, then it's not covered. And those fires are hot. Those fire departments don't put those fires out. They contain them. They would have to use far too much water to put it out. There are some like fire blankets and
devices that
devices,
you can, like,
yeah,
under the car and stuff.
yeah, that can be used to help control the fire and put it out faster, but they burn really hot. In fact, one of the conversations that we've had recently was about the Palisades fire, and did the lithium batteries, the electric vehicles, help propagate the fire because of those batteries burn so hot? Those fires are so hot. The answer from CAL FIRE was actually no, they didn't, only because of the wind. The wind was blowing 100 miles an hour. If it wasn't burning 100 or blowing 100 miles an hour, then they probably would say, yes, there's some component to those fires being caused by these hot spots. But because the wind was blowing so hard, they said it has nothing to do with, don't even look at the batteries. But yeah, the answer to the question, building insurance covers the building, auto insurance covers the auto.
To back it out even further, when you have something happen, something bad happen, a lot of people want to point fingers. They want to place blame on why this bad thing happened, and they want whoever caused the bad thing to happen to pay for the damage. And that's not really how property insurance works initially. If it's a covered cause of loss and the item that was damaged is covered by that policy, then it's going to be covered. Now, if somebody did something really bad that caused it to happen, the insurance company may choose to go after them, but that's later on. When we're talking about property insurance, in most cases, we don't need to point fingers. It's not worth the time.
I can tell you that the association board, if you have an owner who is illegally running a long extension cord and plugging into the association's outlet, and that causes the fire, they're going to be angry at this person, and they're going to be likely to sue that person for having done that.
That sounds like you have experience in something
Yes.
like that. That was a real life hypothetical.
I have a similar experience, and they would have gone after him had he not died in the fire. So there's that.
Oh, okay.
Terri Guest bringing the dark.
Here I am, Debbie Downer. Here I am.
The
Nice to meet
exact
you.
opposite, excuse me.
Yeah.
All right, just to let everyone know, we're 4 minutes over our 12 o'clock, so we're at 1:04. So I'll probably do like 10 more minutes, and then we will either do a follow-up recording of the questions, or you can look to our newsletter. But we will let you guys all know for what's going to happen with that after we discuss it. Is it legal to do a special assessment to cover insurance at 100%?
Yes, it's legal. So it'd be emergency special assessment. It's completely within the board's authority. They can levy it and collect it. You may have some unhappy homeowners, but that's the reality.
Follow up. So January 1st of 2023, our board of directors received an 800% increase in the cost of insurance, and they issued an emergency special assessment. Is it the responsibility of the board then to plan for that expense the next year, or can they do another special assessment?
They should plan for it because they already know, and they have a budget, and that's what the whole budget is about, known operational costs.
Right.
And they know that they're going to be paying those premiums in the next year's budget, so they need to raise the budget, the amount of dues in order to cover that. You know, at some point down the road, insurance costs go down. They can then not raise, or they can reduce the budget or put those excess monies into reserves.
Yeah, I think that's important to note, because a lot of communities, when that started, were kind of crossing fingers. Okay, this is a 1-year thing, and it's not. It has turned into a 5-year thing, and it's going to be a more than 5-year thing. So it's important to really plan for that. As painful as that is, to plan for that additional expense, and then when the market relaxes and we get some regression to a mean, then you can reallocate those funds, or do something that very few communities, in my experience, have ever done, and lower your assessments.
Right. It's rare, but it could happen.
It could happen.
Okay. Miranda.
Right. What happens when we are non-renewed and can't get insurance? What are our options?
You should, well, the California Fair Plan may be an option, but E&S markets, excess and surplus lines markets, should be your first option. If you're working with an insurance professional that is experienced in this industry, they should be able to help you find additional options for your insurance.
Yeah, what I was going to say is, I have not been in a situation where a community was uninsurable. There have been communities that have large total insurable values and are buying very limited amounts of insurance.
Mm-hmm.
For example, a $70 million community in San Diego that has $2.5 million worth of property insurance in place.
Yeah.
Because that's what was available, but that's what was available. So I haven't seen a community. I have not. It doesn't mean it doesn't exist. It just means that I haven't experienced.
For you right now.
Well, I think many of others on the of the members of the attendees here probably are doing the same thing. Shout out to Ryan Gazelle. We have not been in a situation where that has happened. And like Terri said, that's what the excess surplus market is for. That's what the California Fair Plan ultimately will be for, is if there are no other options, then this is the resource. We know, and the thing that the market understands, the things that carriers understand, as much premium as they're charging, they also understand these properties cannot go uninsured. They would devastate the residents. The whole industry would fold if these properties went uninsured. So there's resources. They get more expensive as they get rarer.
I would say that, I mean, if you're being non-renewed or canceled, there are timelines that must be followed, notification timelines. So this should not come as a shock 2 days before you're supposed to renew. You will know about this well in advance. And when you find out, that's when you start working hard, and your insurance professional starts working hard to find options for you. They're not going to be great options probably, but there should be some options. And I have seen folks wait until the last minute, or not be working with an insurance professional that knows where to look, or they don't get notified by their insurance professional until the last minute because they were trying to find stuff and haven't, and there's a lapse in coverage. Sometimes that can't be prevented. So sometimes you're going to go for a certain amount of time with no coverage, but that doesn't mean you stop and accept that as your new reality. That means you keep working.
Can you get multiple carriers involved and layer the insurance?
Yeah.
That's exactly how it's done in the surplus market. So take that $70 million project, for example, or the one I was talking about earlier, that was a 50% insured, and then they bought the next 50%. They buy that in layers. So insurance company offers the first 10, and then you get a carrier that offers 10 million in excess. That's what we call it, in excess of 10. We build that, what we call a tower, up to the total insurable value of the community.
Okay, Miranda.
All right. How will this affect HO6 policies, earthquake policies, or flood policies?
And
If we're talking about premium, strictly premium, I think you're going to see an impact in any policy. The market for property insurance is going to change nationwide because of the Palisades and Eden fires. This is the largest economic and property loss in the history of the country. And Adrian, I think you mentioned $250 billion worth of property loss. That's insane. So that will trickle its way down. The relative impact on, say, an HO6 carrier, earthquake insurance, other types of products, auto insurance, will vary dramatically from carrier to carrier, region to region. But we will all feel it. The earthquake market might be the one you see the most affected. Because that is largely written by these surplus lines carriers, the same ones that are writing the property insurance. So, and then they're reinsured by the same reinsurance companies. That is, insurance companies buy insurance for their insurance to diversify their own risk and protect them. And those carriers are going to be raising, because this is impacting reinsurance carriers, they'll be raising their rates, they'll be passing it down. So I would expect earthquake carriers, that earthquake market, to be the second most affected, other than the fire property insurance.
So if I'm hearing you right, they're going to be all across the board, all insurance rates are going to go up in order to help cover the costs, the losses and the fire insurance?
I wouldn't say help cover the costs. I will say the rates are going to go up because of two factors. One is what we've discussed at the beginning, that carriers aren't pricing their risk the way it needs to be priced anyway. They haven't been able to keep up with the market or keep up with inflation, let alone their claims costs. So the market is going to adjust in that respect. And then the carriers are going to they're going to be paying more because they're paying more for the insurance that they're buying on their own exposure. So that's going to get passed down to the customer. The one thing that we are battling back and forth with is, what is the California Fair Plan going to do?
That's what I was going to bring up.
So I'll let you dive in. What is the Fair Plan going to do, Terri?
The Fair Plan does not have enough money to pay for all of the claims resulting from these fires. So what they do, and this is written in on every Fair Plan policy, there's going to be an assessment to all of the policy holders. There's going to be an assessment to all admitted carriers in the state of California, who can then pass that on. So are we going to be paying for this? Yeah, we probably will be directly by being assessed by these carriers for that fire. And then also the reinsurance prices are going to go up, and so on and so forth.
We're all going to feel it.
Everybody. Yep.
Waterfall effect, right?
Again,
guys?
Debbie Downer.
All right, well, we're at 1:15, so we're going to go ahead and wrap it up. Thank you again to all of our attendees and speakers. As always, please do not hesitate to reach out to us with your questions. We'll see you next time, and don't forget to check our YouTube channel or the newsletter for additional questions being answered from this webinar. Thank you, guys.
Thanks, everybody.